So we've got one more audience question come in. So Henry Nickel writes, what is the maximum interest rate the market anticipates to reprice UK equities? I think I've understood that correctly. So does anyone want to come in on that? That's quite a, I guess we have to ask the Bank of England, don't we, on that? But are people looking at a maximum interest rate, and how might that affect the performance of UK prices?
I mean, if I may start, we 3 weeks ago actually looked deeply into this topic of not so much about how much is priced into the market, but how far can the Bank of England go and sustain higher interest rates. And the answer is actually quite depressing. So this is the German coming out here. Given the amount of debt that is in the system, and I'm less concerned here about mortgage debt than household debt, because households have delevered quite a bit since the housing crisis of 2006 to 8, but mostly about corporate debt. And as the Bank of England increases rates, that filters through over time into higher bond yields and higher interest rate costs for corporates if they replace an existing loan with a new loan or an existing bond with a new bond. And that very quickly makes investment growth really hard to attain, because if you increase from 0.5 bank rate to, say, 2.5 bank rate, and you add maybe a credit spread of 200 basis points, effectively you're doubling the cost of debt for a corporation. And all of a sudden, half of your investment growth capital is no longer there, because you have to pay it in terms of servicing your debt. And that's what really worrisome. And to cut a long story short, it seems like that even if the bank goes all the way to 2.5-3% bank rate, that is an unsustainably high level of interest rates in the corporate sector, and will inevitably trigger a slowdown in the economy that might end up in a recession and force the bank to cut back down again to 2% and below.
Oh, that's an interesting point. I mean, that sort of puts the private equity interest in UK corporates into some perspective as well, doesn't it? I think you could clearly see. I mean, Eloise, what would you have a view on that? I mean, private equity has been hoovering up British companies. I mean, is that a debt-led? But could they be causing a debt-led problem there?
Yeah, partly. I mean, even though the market hasn't had an appetite for UK companies because they were assumed too difficult, somebody's been buying the UK shares, and that's been the private equity. So, I mean, the valuation discounts are largely, we believe, unwarranted. And so UK-listed companies continue to be picked off by overseas private equity buyers, and overseas industry peers are really taking advantage of the lower valuation, particularly in the wave of mergers and acquisitions. So,
yeah, I mean, what's your take on that, Simon? Have they? Are we going to see that wave tap out now? I mean, what's your? I mean, we're not really talking about.
No, I think it's likely to carry. I think it's likely to carry on. Actually, I think one of the other things about the UK is that the rules are very clear in the UK for takeovers. I mean, you have the Monopolies and Mergers Commission. The government has changed the rules a little bit for technology transfer and national security, but essentially, if you've got a standard business and we are open, the market's open to takeovers, whereas the rules in many other countries are more complicated. And if you couple that with low valuations, with a lot of money in private equity hands, and many of these funds raised money last year either from new issuance or from selling other businesses, so there's plenty of money around. I think the UK is likely to continue to be a place where companies look to take advantage of those opportunities, and either corporate buyers or private equity buyers. I would push back a little bit on Joachim's comments about interest rates and a problem for the corporate sector, because the corporate sector, at least the listed corporate sector, has quite modest levels of debt at the moment. It's refinance compared to where we were pre-financial crisis. The levels of debt are much more manageable, and of course, corporates have funding that goes back many years in most cases, so that the sticker shock of rates going up takes a long time to feed through. So for most of the big companies we look at, we're not too concerned about higher levels of interest rates. I think the government's got a lot of debt, And the impact overall on economies of how much debt is sustainable is a really good question. And I think you're probably right to say that rates can't go too high because from an economic point of view before it does start to impact activity. But I think corporates we look at, we're not so worried about the rising cost of debt in terms of their ability to finance themselves and carry on. I think you could see some profit warnings because of the refinancing risk, which in some cases, and it's very stock by stock, but if they happen to have a big refinancing coming up and their earnings might be under some pressure because of the macro situation, you could see the odd profit warning because of the cost of debt, which we haven't had for a generation really, because cost of debt's been going down in one direction. So I think that's something to watch for with highly leveraged businesses. But I'm more relaxed about the big companies and their ability to finance themselves at slightly higher interest rates.
Okay, perfect.
Which doesn't not to say that I think not to say that I think rates are necessarily going to keep going up forever. I think there's good reasons why inflation might roll over and why rates might come down anyway. But I just don't think it's a massive issue for the big companies.